Yes Bank reported a 90% decline in profits in the first quarter. Provisions against stressed assets on its books eat into the bottom line. Shefali Malik, she's standing by right now to run us through the fine print of Yes Bank's numbers. Management is of the opinion that they've got the house in order in this quarter, and next quarter onwards it's going to be a turnaround. It doesn't really look believable.
Well, yes, it doesn't really look believable. Even at the time of Q4, when the management said that, now it'll be consolidation, etc., they guided for 125 basis points credit cost. That time also, and a watch list of 10,000 crore rupees. That time also, there were several question marks raised that, whether this is believable going by the history. So even now, when the management has put out and they're trying to tell the investors that it's all in order, but, not many are believing the same. So starting with what they actually did in the quarter, their NII went up just 2.8%, which was below expectations. Profit fell 90%, again below expectations. Then NPAs rose sharply. The gross NPAs in absolute numbers went up 53%. In percentage terms, 5.01% against 3.22 on a sequential basis. So a sharp rise there as well. Net NPAs as well because of higher provisioning. So net NPAs went up to about 2.91% versus 1.86%. And provisioning, if you remember in Q4, they did about 2,100 crore rupees contingency provisioning for the watch list accounts. So out of that 2,100, they actually used about 1,400 crores. And as far as the fresh slippages are concerned, management said it was to the tune of about 6,200 crore rupees. Out of that, 2,500 crore rupees is the one which actually slipped from the watch list guided earlier 10,000. And yesterday in the con call, management again guided a watch list of about 10,000 crore rupees. So that means if had these, that means they've added it. So that means had these accounts not slipped, the watch list would have been 12,500 crores. So that's one catch there. Other than that, provisioning went up, came in at about 1,784 crore rupees, 51% lower than what it was in Q4, and the coverage ratio is just about 43%, which is a big concern for them. And other than that, credit cost came in at 32 basis points in this quarter. Guidance has been maintained at 125 basis points, which does not look believable.
All right. So, obviously the management had its con call. What were the key takeaways from that con call specific to the asset quality?
One of the big points in the con call was that the BB and below book, that is a below investment grade book, that has risen very sharply from 23,000 crores at Q4 end to about 29,000 odd crores. And the 6,000 crore rupees gross slippages that have happened, out of that 2,500 crore rupees is coming from the earlier watch list, which I just talked about. So that is, a rest came from the sub-investment grade book. Their BB and below book increased sharply, mainly on account of downgrade of two financial services companies, which we've spoken about in last couple of months. Watch list, they say, continues to remain 10,000. And also, other than that, they're saying that 25% of real estate exposure is in BB and below book. So that is one big number which we have to watch out for, considering the stress in the real estate sector as well. 125 basis point credit cost guidance does not include the MTM on the investment provisions. So all these downgrades that have been happening of DHFL, ADHE group companies, Z, etc. So the investments that they have in the bonds of these companies, so that the provisioning that they need to make on those accounts, so that has hit them in this quarter. Okay. And if they actually, these companies, more such downgrades continue to happen, what's going to happen to those investments, and whether there will be a further markdown to the investments that they already have. So that is one key thing to look forward to.
Yeah, and the other part also that I was going through some brokerage notes which suggested that this time around, while the slippages have been more than 10% of the account of the BB rated book, the BBB rated book could be another concern as we move forward.
Yes, absolutely, because like so many accounts that we've been watching in last couple of weeks, they've been witnessing downgrades after downgrades. So we do need to watch out for these grades as well.
And the capital raising that we've also been talking about. Even if they have to do $1 billion worth of capital raising, their current CET tier 1 is about 8%.
8%.
That's the regulatory level that they have to be at.
Yeah.
Even if they raise about $1 billion, you take that up to 11%.
Yes.
Is that enough? I mean, the growth capital, it doesn't seem to be enough.
Yes, doesn't seem to be enough. So all eyes would be how much they actually end up raising. The management said that the dilution could be more than 10%. So the first tranche, as we reported earlier, could be from a PE player. So we need to watch out for that, how much they actually raise. And because of that capital raising, how the overall business momentum also picks up in the bank. So that also may contribute to their overall earnings simultaneously. But then purely standalone, the amount doesn't look, enough.
Sufficient, yeah.